Dollar General sells cheap basics to small-town America, and for a while, Wall Street treated it like a growth stock. Then it lost more than half its value. That's when it got interesting. And the whole game here is one number, the margin. Out of every sales dollar, about 6 cents reaches operating profit today. A few years back, it was 9. That drop is what broke the stock, and winning those 3 cents back is the entire bull case. So what happened? Shrink and theft spiked, costs climbed, the stretched shopper pulled back, and margins caved. The stock caved with them from 256 at the peak down to 71, but at the bottom it was genuinely cheap, and then it ran right back up past 100. And that's the catch. Fair value lands around $92. The stock trades above it to pay $106. You're not betting the margin recovers. You're betting it jumps all the way back to 9%. Management is only guiding to 6 or 7. You're paying for a best case the company won't even promise. And it has to pull that off carrying a heavy load, $15.8 billion in debt against $1.5 billion in cash. It earns a few $100 million in free cash flow a quarter, which barely moves a debt pile that size. There's no room for a misstep. The scorecard doesn't flatter it either. Business quality is middling. Valuation, the balance sheet, the risk, they all score low. This isn't a wonderful company at a fair price. It's a fixable one the market has already priced for the fix. So I asked the analyst where that $92 number even comes from. The answer, grow revenue about 7.5% a year for 7 years, lift the operating margin from under 6 up towards 7, then discount it all back to today. That's the base case, and it already assumes the turnaround works. At 106, the market is assuming even more. Now the bear case, and it's real. The core customer is tapped out, squeezed by fuel and shrinking benefits. With $15 billion in debt, one bad year doesn't just dent earnings, it threatens the whole thing. If the margin recovery stalls, this model doesn't drift lower, it points all the way down toward $14. The one thing to watch, operating margin slipping back under 6%. So the verdict through a deep value lens, too expensive. Not a bad business, just the wrong price. Fair value sits near 92, and the lens won't get interested until the price is closer to 50, less than half of today. The confidence is high, 77, and that's a read on the research, not a signal to sell. The full breakdown is at Cersus.io. Stock analysis for modern investors.